For a brief stretch in Tokyo, traders watched bids thin out as if someone had quietly stepped away from the market. Minutes later, U.S. stocks pushed higher anyway, riding on capital that no longer knew where it would settle. Reuters later noted that Japanese banks were repricing overnight funding at the same time Washington ruled out any currency support. That single decision changed the balance. Scott Bessent closed the door on intervention. Japan was left to defend its currency alone. As the yen slid, Chinese lenders expanded renminbi credit through Hong Kong, and President Trump publicly warned Britain and Canada against moving closer to Beijing. None of it was planned together. But by the end of the day, the world's safest trades were suddenly leaning on the weakest currency in the system. That fragility rests on a quiet imbalance. Bloomberg has documented that Japanese investors now hold more than $2 trillion in U.S. stocks and bonds. Nearly $450 billion of that exposure is tied directly to the yen carry trade, money borrowed cheaply at home and deployed abroad. The strategy assumes two things never change at the same time: the yen stays weak and Japanese yields stay suppressed. Both assumptions are now under pressure. The sell-off that flickered across U.S. markets in recent days barely registered to retail investors, but inside macro desks, it felt like a stress test. If the yen weakens further while yields in Japan keep climbing, the carry trade doesn't unwind slowly. It snaps. And when it snaps, capital does not rotate carefully out of U.S. assets. It rushes. Japan is running out of room because every traditional lever has already been pulled. After more than a decade of aggressive money printing and yield suppression, the Bank of Japan has distorted its own bond market to keep borrowing costs low. That policy worked when global trade was cheap and energy was abundant. Since the Ukraine war and the return of tariff escalation under President Donald Trump, that world has disappeared. Imports are the pressure point. Japan imports roughly 90% of its energy, and every tick lower in the yen immediately raises the cost of electricity, fuel, and transport. Financial Times reporting has shown how these costs feed directly into consumer prices, a shock for a society built around deflation. IMF projections now show Japan's medium-term inflation expectations running hotter than those of the United States by 2026, an inversion that would have been unthinkable a decade ago. That shift is politically dangerous. Prices rising in Japan do not just strain households, they destabilize elections. With a snap vote looming, currency weakness compounds the sense that the government has lost control of the economic narrative. A falling yen raises import costs, pushes inflation higher, lifts bond yields, and scares investors away from Japanese government debt. Each step reinforces the next. In the past, this is where Washington stepped in. Coordinated intervention between the U.S. Treasury and Japan involved selling dollars and buying yen, sending a signal that allies would not be left to the mercy of speculative flows. This time, that backstop vanished. Earlier this week, Treasury Secretary Scott Bessent publicly rejected any idea of intervening to support the yen, reaffirming what he called a strong dollar policy and declining to comment beyond that. The market response was immediate. The yen weakened again, exposing just how dependent Japan has become on external reassurance. Bessent's position is not ideological, it is defensive. After President Trump openly praised a weaker dollar in Davos, markets reacted fast enough to force a reversal in tone. A plunging dollar does not just help exports, it corrodes the real value of U.S. stocks and bonds. Let it slide too far, and the entire asset complex starts to wobble. That fear now outweighs alliance management. By refusing to support Japan's currency, Washington effectively chose to defend the dollar even if it meant sacrificing an ally's stability. The result is isolation. Japan must now stabilize the yen alone, even though, every unilateral attempt has failed in the past. The Bank of Japan's bond buying plans reveal the bind. According to data cited by Bloomberg, the BOJ is scheduled to purchase roughly 2.9 trillion yen of Japanese government bonds in the first quarter, while simultaneously talking about reducing its footprint later in the year. The problem is demand. If private investors keep backing away as inflation rises and the currency weakens, the central bank will be forced to absorb even more debt. That creates, a paradox. The more bonds the BOJ buys, the more the market sees monetization rather than stability. Foreign exchange traders price that risk instantly. Inflation expectations rise. The yen weakens further. The intervention meant to save the system ends up accelerating its decay. With rates constrained and bond purchases losing credibility, Japan's remaining option is the one it has tried hardest to avoid. Japan is the single largest foreign holder of U.S. Treasuries, with holdings exceeding $1.2 trillion, according to U.S. Treasury data. Those assets can be sold, they can be converted into yen, they can be used to stabilize domestic bond markets. But doing so would send shockwaves straight through U.S. financial markets. Large-scale Treasury sales would push U.S. yields higher and force a repricing of equities built on cheap capital. For years, this threat existed only in theory. Scott Bessent's refusal to coordinate has made it operational. Japan needs a stronger yen to contain inflation. The United States needs a firmer dollar to preserve asset values. Both outcomes cannot coexist. Markets are already sensing that collision. The Wall Street Journal reported renewed demand for gold alongside equity volatility, a sign that investors are hedging currency risk rather than fleeing growth. At the same time, President Trump signaled a harder line on monetary policy by preparing to nominate Kevin Warsh as the next Federal Reserve chair. Of the names discussed, Warsh is widely viewed as the most hawkish, implying rates could stay higher for longer. What sharpened the break was timing. As Scott Bessent hardened the Treasury's strong dollar stance, Japanese banks were already rolling short-term funding at higher rates, forcing yen hedges to reset overnight. That same window saw the People's Bank of China quietly expand renminbi settlement quotas for energy and metals trades routed through Hong Kong, according to people cited by Bloomberg, aligning currency liquidity with physical supply chains. Days later, President Donald Trump amplified the shift by endorsing Kevin Warsh as his preferred Federal Reserve chair, signaling tolerance for tighter financial conditions, even as allies strained. In London, Keir Starmer's delegation returned from Beijing with draft frameworks on electric vehicles and battery inputs, while Canadian officials privately acknowledged similar talks after Trump's warning. In Beijing, President Xi Jinping's strategy stayed methodical. Zijin Mining's latest gold acquisitions locked in output for years, reducing reliance on dollar-priced markets, just as offshore yuan lending hit record volumes. None of these moves required coordination. Together, they rewired incentives. Japan is now cornered by markets, China is pricing the future in its own currency, and Washington is defending the dollar by letting pressure fall where it lands. That nomination was a signal. While Washington and Tokyo strain against each other, Beijing is moving with quiet precision. In recent days, Bloomberg reported that the People's Bank of China expanded its renminbi liquidity facility into Hong Kong, lifting the size to roughly 200 billion yuan. The objective is simple: flood the region's financial hub with cheap Chinese currency to meet growing global demand. Hong Kong remains Asia's primary financial gateway. Renminbi funding there is priced off Shanghai interbank rates, with one-year lending costs near 1.6%, less than half comparable United States borrowing rates. For importers buying Chinese goods or firms expanding supply chains tied to China, the choice is increasingly rational. Borrow in yuan, spend in yuan, repay in yuan. This expansion did not happen in isolation. After President Trump's remarks in Davos, doubts about the dollar's long-term stability resurfaced across capitals that had long dismissed the issue. Even without sanctions risk, holding dollars carries opportunity cost when cheaper, liquid alternatives emerge. For countries whose trade flows already center on China, renminbi settlement feels less like ideology and more like efficiency. The numbers confirm the trend. Financial Times reporting, based on BIS data, shows offshore yuan lending has exploded from roughly 600 billion yuan 4 years ago to more than 2.5 trillion today. Each loan creates future demand. Borrowers must earn the currency to repay it. If the renminbi appreciates, the incentive only grows. China is reinforcing that ecosystem by converting its own reserves into physical assets. Reuters has documented surging precious metal demand inside China, with domestic silver prices trading well above global benchmarks. At the corporate level, Chinese miners are locking in supply. Zijin Mining recently paid a significant premium to acquire African gold assets, signaling confidence that bullion will outperform Western fiat currencies over time. This is not accumulation for speculation. It is balance sheet repositioning. Gold and silver sit outside the dollar system. Mines produce future supply that cannot be sanctioned or inflated away. China is exchanging paper claims for tangible control. As Beijing builds alternatives, Western allies are recalibrating. UK-China trade surpassed £100 billion last year, according to official British data. Prime Minister Keir Starmer's visit to Beijing was framed as commercial diplomacy, but the agenda ran deeper. Access to Chinese electric vehicle and battery technology featured prominently, a potential lifeline for Britain's weakened manufacturing base. From Washington's perspective, this looks like erosion. President Trump has publicly warned that deeper UK-China ties are dangerous, grouping Britain with Canada in his concerns. His reaction is not personal, it is systemic. Every trade settled outside the dollar system weakens the financial architecture that underpins U.S. power. China's strategy for 2025 and beyond is not about abrupt rupture. It is about optionality. reduce exposure to U.S. demand, secure trade flows in local currency, build financial plumbing that works even if the dollar stumbles. Each step expands freedom of action. Japan's crisis accelerates that timeline. If Tokyo is forced to sell U.S. treasuries to defend the yen, it will demonstrate that even the most conservative allies will act in self-interest when pushed. If Britain deepens its economic alignment with China, it signals that security partnerships no longer dictate trade exclusively. Nothing in this system breaks all at once. Pressure accumulates quietly. A currency weakens here, a funding line expands there, a bond auction clears at a higher yield than expected. The story will not announce itself with a single collapse. It will reveal itself through choices made under constraint. Japan now faces its most dangerous decision in decades: defend the yen and risk destabilizing U.S. markets, or protect the alliance and absorb inflation at home. China is betting that more countries will soon face similar trade-offs. And as Washington defends the dollar from its own excesses, the question is no longer whether alternatives will grow, but how fast the world adapts when the old guarantees no longer hold.